Hi, my name is Marina Miller from Group 4, and I will be presenting about Misty Mountain Furniture, which is a small hand furniture company located in Sandpoint, Idaho, and they're currently on the market for $274,000. They specialize in making custom cabinets and different types of furniture, as well as beds and all sorts of different things. I'm presenting on the free cash flows, net present value, and the IRR. So I'll just go over to the spreadsheet really quick. Let's see. Okay, let's see. Okay, here we go. Okay, so here's our spreadsheet. Our free cash flows begins with our cash, calculating the cash from operations. And this is done by finding the operating profit, which is calculated right here. And it's actually the sales or operating profit plus the depreciation. So you add back the depreciation. And then right here is the depreciation expense, which is then taken from the operating profit. The taxable operating profit is the operating profit minus the depreciation. And the taxes they're calculating using the current year's tax rate. And the taxes are subtracted from the operating profit, which gives us our cash from operations. And this is done for all 10 years. Next is our cash from changes in balance sheet. And these are calculated by taking next year's land minus this year's. And so you can see in year 0, it's negative because of the purchase of land as well as the purchase of buildings and equipment. And then those are actually added back from the adjustment from a sale for both of those, or actually just for the land and not the buildings and equipment. And so there's no taxes on this because you don't make any money from the sale. Let's see. Next is the working capital. And this is just the cash, extra cash, accounts receivable, and inventory, and accounts payable next year minus this year for all 10 years. And these, let's see, accounts receivable, extra cash, cash, and inventory are all negative because they're money that's being spent, while accounts payable is money that's going to be coming in. And so that gives us our total free cash flows, which is just the sum of our cash from operations all the way down to our accounts payable, our changes in the balance sheet. Next, and then that's calculated for all 10 years. And I plugged in our WACC right here. That was calculated before from our forecast. And the present value is calculated just by using the present value formula in Excel, and it uses the WACC and the total free cash flows for that year. And then when you add all the present values together from all 10 years, that's when you get the net present value, which is about $272,000, which actually is very close to the selling price for the business, which is $274,000. From the total free cash flows, we figure out our IRR using the IRR formula, and it basically just calculates the total rate of return over all 10 years, which for our company is 12.05%. And that's the total free cash flows and the net present value and the IRR.